There's been several studies that have come out recently saying that the biggest risk to someone's retirement is longevity now, because healthcare is improving so much that people are living much longer than a 30-year retirement.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. The advisors discuss some of our firm's investment processes. These are just a few of the many possible approaches to investing. Individual results may vary depending on your goals, risk tolerance, market conditions, and other personal factors. Please consult a qualified financial professional before implementing any investment strategy.
Welcome to the Market Moment. This is Matt here today with John.
Good morning.
And Eli.
As always,
Eli's, I think,
happy to be here.
Eli's, I feel like I'm sitting between two stars.
Oh, yeah.
Y'all are popular.
They've aligned.
Oh, gosh. Okay. Well, so today we got a couple good things we're going to talk about. We're going to talk about, I think it was last week. Zoe, was it last week we started the frequently asked questions? So, Week two, we are walking through every week moving forward kind of the question of the day or the frequently asked questions that we commonly get from clients, listeners, that just seem to come up all the time. So we're going to just start kind of working our way through those. And so we'll talk through that and then a couple topics that Eli's got for us. So regularly asked question, one that we get all the time is, how much do I need to retire? Right? So as we often do, this is very personal and it depends. But I'm going to walk you through what I would do in front of, if someone came up to me on the street or if it was a client and they're like, hey, how much do I need to retire? And it was like back of the napkin. Hey, let's just kind of throw out a number that's probably close-ish just to kind of give you a general idea. And then we're going to talk about all the variables and why that's a horrible way to do it. But if you look at, let's assume you are someone who's nearing retirement, not too far away, and you need, I'm going to use $10,000 a month. That's a nice round number to support your lifestyle. So that's the income that you're going to need to continue to come in retirement. If first we would take, so again, we're trying to calculate how much you need to retire. So what size of does your portfolio need to be? Let's say you have Social Security between you and your spouse, so you're married, of $6,000 a month, okay? And you have no pensions, as most people don't have pensions anymore, and no other regular stream of income. So no rental income, no annuity income, no, it's Social Security is it. So what I would do is, okay, so we need $10,000 a month. We've got $6,000 a month from Social Security. So there's a $4,000 gap that we're going to need to fill, right, from an income perspective. So $4,000 is $48,000 a year. And if you take the kind of widely used 4% withdrawal rate, you take $48,000 divided by 4%, that gives you $1.2 million. Okay? So that is a very quick / horrible way to calculate how much you need to retire. But if you're wanting just a super vague, super general kind of number to gauge where you're at or what your kind of target needs to be, that's a way to go through it. What is your monthly income need? What is going to be your regular monthly income from kind of more secure, steady sources? What is the difference on an annual basis? And then divide that by 4%. That gives you a round number. So now tear that to shreds and why that doesn't really work.
So I get really excited about this because there's different parts of this that truly they matter quite a bit between individual to individual. The first part that I like to note from what you just did, Matt, was if you were listening and you were a keen viewer, you noticed that he started with expenses. So you start with not how much do I need, it's how much do I have, it's how much do I need every single month. And so coming up with a true kind of guesstimate towards your expenses is the first step. However, in working with hundreds and hundreds of clients, you know pretty quickly as soon as someone guesses their expenses, they're wrong. And whenever they guess their expenses, they typically are missing the lump sum expenses that come every 5, 10, 15, 20
Vehicles,
years. So that's the
healthcare.
That's the first note that as you were speaking, I was thinking through. One, most people guess their expenses wrong. And two, they lack planning for those big lump sum offhand expenses.
Right.
Well, and things have changed. I mean, when I got years ago into this business, which are just math you did there. The old rule was 5%. So instead of 4%, it was 5%. But it's also the rule, and that's when interest rates were, before we went through a 15-year, 0% interest rate environment. But it's also that math, just going back to your simple math, right? That's is if you wanted to leave that $1.2 million behind when you passed away.
Yeah, that's
assuming,
sure.
and taxes have to be associated with this and all that kind of stuff. So when we're doing review or financial plans, its expenses are a massive, most important question to get answered, right?
Yeah.
And get accurate expenses. But it's also, what do you want to leave behind? What are your charitable intentions? What's your legacy? Like, everything matters when you're determining how much you need at retirement. And
Sure.
I think it's such a massive, it's a very easy question. So every time I hear that question, I was pulling up a company that we know very well, and I won't say it just for whatever reason, but they have this thing that you need to save 10 times your income by age 67. So whatever your income is when you retire, you need to have 10 times that amount put away. And we kind of laughed about that because that same company says that by age 32 or 35, you need to have 1 times your salary saved. And like, that's fine. Those are all.
I think of a lot of these things as like the time salary, or even the math I did, kind of getting almost like a Dave Ramsey approach. It's like, it's generally not correct, but it gives you something to like
shoot for.
A guideline.
Yeah. And it's like, it's better than not having any idea and not having a goal that you've set. And so it's not mathematically probably the best way to go about calculating like what do you actually need. But if you're trying to get a very, very, very rough number to shoot for, some of these 10 times your income, or the 4% withdrawal rule, and dividing the income gap by that and all that is a decent way to do it. But Eli, walk us through why, one of the biggest variables is not just how much you have, but where those assets are being held.
Mm-hmm. So not all assets are created equal. And when I say that, I'm thinking through 3 different types of accounts. You have your traditional IRA or 401k. You have your after-tax account. Think of it as like your bank account or maybe real estate, brokerage accounts. Mm-hmm. And then you have Roth. And that's the tax-free. If you take distributions, it comes back tax-free. So if we're going to say you need $1.2 million, and I have $1.2 million in Roth, and you have $1.2 million in pre-tax 401k, well, that creates a very different form of income, because everything that you distribute is going to come back to you. You have to pay tax on it. Whereas everything I distribute, I don't have to withhold anything for taxes.
Right.
So that's another variable that you have to be concerned with, is where is your asset structure whenever you're distributing. And if you do have everything pre-tax, if you say $3,000 a month, that's $36,000 distributed before paying taxes.
Right.
So you might actually need to have more than that.
Yeah.
Is it your guys' experience that folks my age or older have less Roth? Right, it's been
correct.
Roth was not exciting.
That's generally true.
Right, so it's a whole different story for folks getting in retirement right now or already in retirement, because Roth was not the big thing in the 80s, 90s, 2000s when you're building. Today, every single young person I talk to, it's like, do as much as you can afford into your Roth.
Mm-hmm. Yeah.
Right, make the Roth be the number one place you invest, because it's. So 30 years from now, it'll be a lot easier for us to do financial plans for people, because a lot of assets, hopefully, will have taken advantage of the Roth.
Yeah.
I think the current situation, there's a lot of people that come into our office that we have to do special things to get them into that Roth. This is something silly, but I kind of look back on my career of doing this, and I think of it like at age 75, I have 2 types of clients. Now, this is not right 100%, but just hear me out on this. Somebody at 75 that has too much money, they're never going to spend it all, and they're going to pass away, and it's going to be passed down to their kids, and they've never learned to spend. It's always saving their whole life, and they're fine, and they're going to leave lots of money behind, and their kids may blow it or whatever, but they just don't have the habit of spending. Then I have clients that are going to run out of money at 75, and when they get to 75, by nature of law, right, they're going to have to learn to live on their Social Security. So you don't want to be in that situation. The whole point about planning and using advisors is that we try to stretch that out as far as we can. But sometimes it's tough conversations, right?
Sure.
So how much do you need to retire? This is a great question. If you're 25, 30, 35, 40, we can solve that equation. Mm-hmm. If you're 60 and you're asking that question, it might be a tougher
Another thing,
deal.
100%. Another thing we haven't gotten big into, but how are you taking into account like inflation? So you mentioned like the larger expenses. So that's just kind of your standard monthly income. What about new vehicles? What about trips that you want to do above and beyond that? What about healthcare? Is all of that baked into your monthly budget? Or if it's not, then that starts to make a big impact. And then how are you adjusting that for inflation? Are you assuming you take out a flat amount and you adjust your standard of living down over time as that purchasing power gets diminished? Or are you adjusting those withdrawals, up to adjust for inflation? So there are so many it's like this weird dynamic. Financial planning, investing is not that hard, and at the exact same time it's really complicated and kind of hard. There's a lot of nuances and a lot of things that go into it, and some people oversimplify it to their own detriment, and some people overcomplicate it to their own detriment. And there are a lot of things and variables that you have to take into consideration if you're wanting to plan well and make sure you're setting yourself up for success.
When we do plans, when we said that 4% right off the bat, the old napkin thing, think about 4%. The S&P 500 has averaged over 10 since the inception of the S&P. So getting 4 means you're very ultra conservative. So that's another variable that we haven't talked about. How are you invested?
Mm-hmm. Sure.
Like not just a Roth or traditional, but are you invested in stocks? Are you invested in bonds? Are you invested in CDs? And all of that matters as well.
When the 4% rule was developed, assuming that you are holding a 50% allocation to globally diversified equities and a 50% allocation to globally diversified bonds.
Right.
And I would guess that 90% of our listeners aren't holding globally diversified stocks and bonds for 50-50 of their portfolio.
Sure.
But if they were, they would make more than 4%. I mean, we can't, that's not proof, but history says that.
Yeah.
Right? So, you're right. I mean, these are all many variables in these simple,
the second
to your
part,
point.
The second part to that is Matt based all of this off of a 4% withdrawal, and that's built off of a 30-year retirement. Mm-hmm. Well, there's been several studies that have come out recently saying that the biggest risk to someone's retirement is longevity now, because healthcare is improving so much that people are living much longer than a 30-year retirement. And so if you're 65, planning for a 30-year retirement, great, that takes you to 95. But if healthcare continues to develop, we're going to have people living into their late 90s,
sure,
early 100s in the next 20, 30, 40 years.
Yeah.
And so a 30-year retirement looks very different, and a 4% withdrawal may actually be too aggressive.
Yeah. Or if you retire earlier, or if there's there's an age gap between you and your spouse, right? If your spouse is significantly younger, there's just, we could just continue to go down the list of things that we have to take into consideration when putting together a plan.
Last variable I'll bring up, all young people, and I say young people, like you young people, one trend I've noticed, my older clients, like their 70s and 80s, they worked until 65 at a minimum, some 70, right? Even if they didn't have to. I often find when you ask that question to your clients doing reviews for somebody that's 35, when do you want to retire? And a lot of it's 50. 55. And that's a common. I mean, I'm getting that a lot. And when you do that, now extrapolate that, they're going to work
50-year
less years than they're going to live in retirement.
I think the difference in that, this is a good conversation. I think the difference is, not to speak for everyone out there, but just generational differences. The older generation was work, stay loyal to your employer, work until you retire, and then don't work.
Right.
And I think like the younger generation is more of like, no, I'll put in my time, try to go make the money.
Yeah.
Corporate America, start a business, whatever that is. But then I want to get to a point where, I may still work. I'm working because I want to. I may still have some income, but it's not like, hey, I'm going to go just not do anything, like retire, like sit on the porch or not have any sources of income. So I think it's just that flexibility. So it's like how you're defining retirement has even changed, and what that looks like for a lot of people.
And I have plenty of people retire needing an 8% withdrawal rate for the first 7 years.
Yeah.
Then it goes down to a 1 or 2% withdrawal rate when Social Security or pensions kick in.
Exactly.
So you have to give yourself a big picture, take into account your age, your life expectancy, your asset structure, your spouse's age, your health. I mean, I can continue down the variables that you need to take into account. But a very good general rule of thumb is use Matt's, then if you start to introduce variables that seem like they're worse,
adjust accordingly.
Maybe drop the 4% down to 3%. If
Right.
you're going to retire in your 30s, maybe down to 2%. I mean,
Right.
Yeah. And so much of the generational difference of defining retirement and what's important to these people and us is just, how we were raised, right? The older generation was, coming out of the Depression era,
Exactly.
and their parents were going through, and so like security and work and was just viewed very different. And it's not that one is right or wrong, but it's just, we were brought in different eras.
My younger clients do not worry, and I mean, whether this is right or wrong, but they don't worry about FDIC at all. My older clients often worry about FDIC, and there's a difference of just generations of what they went through.
Yeah. So really good conversation. I don't know if it was helpful at all, but that's just trying to answer the question of like, how much do you need to retire? A back of the napkin way to calculate it, but then all of the variables that quickly start to change that number and make it something different. So Eli, last 5 or 10 minutes here. Let's talk through a couple things on the market and rates and kind of what we.
So there's a couple tweets. Do we still call them tweets when it's X?
You're asking the wrong crowd. I have no idea.
There's a couple tweets from people that I appreciate their insight, both of them around what the Federal Reserve did this last week. So the Federal Reserve had their Jackson Hole meeting, came out, just discussed some of their forward guidance as to what they're expecting for rates. When they did that, Friday was an upward move in the market. So Ryan Detrick, he posted on X, Friday was a rare 90 of 90 day, meaning 90% of the volume on stocks on the New York Stock Exchange were higher. These events tend to be quite bullish, with the S&P 500 higher more than 90% of the time 1 year later and up more than 23% on average 1 year later.
I'd take that.
Yeah, sign me up.
The only time that it was negative in a big way, and that was 2017. It was down 24% a year later.
Wow. Interesting.
But
Yeah. Most people, my mind went immediately to, it was probably 2000 or the great financial crisis, not thinking about specifically the rates, but you just think of a big drawdown.
Right.
You immediately, but it's like, no, it's 2017.
Yeah.
That's really interesting. So 90 of 90.
Mm-hmm. And that's coming off of 2 back-to-back 20% years, and we're currently in a 10+% year right now. So seems like it's what a lot of people are now commentating is it's the beginning of a bull market. We're still in the early stages of a bull market. That is a fairly new and recency bias take.
Well, yeah, and it's kind of how you look at, you had 22. 22 is a hard year.
It was. Everything went down.
It's easy to overlook. Everything went down.
Mm-hmm.
Everything.
I mean, the S&P was down 20-ish%.
Yep.
Right. I mean,
Bonds were down.
It was not immaterial, negative market or down market.
The best asset was cash.
Yeah. That's never a good thing.
That was our worst year since 2008. Was 2022.
Like calendar year.
Calendar year. Yeah, calendar year.
Yeah.
Not point to point, but calendar year. So we've had, in my little looking back, I feel like we've been on a 16, 17-year bull run. Mm-hmm. Now, I know, obviously, by the rules, we haven't. We've
had some different.
We've had some stuff. But it feels like we have just been on a tear. So I'm happy to hear those kind of stories. I love hearing that.
Yeah.
But I also think, like, there's so many things that have to be worked out. October, our government gets back together to work on the national debt, right, or the budget,
right?
And I think that's going to be
a
massive issue with the markets might look at that, and depending on how it goes, right, it could be great. I mean, we could start cutting the deficit rather than adding to it.
So you said this year has been a 10+% year. I was looking at the major indexes yesterday. Through yesterday, it was like Dow was up 7. NASDAQ up 11.5. I think S&P was up right at 10. So 7 to 12% kind of on the major indexes year to date, with a 20% pullback in the middle, which is crazy. So in the last 8 months, we've had
all kinds
good
of
growth, but there's been a fair amount of volatility along the way.
So second post, this is from Bill Gross, who's known as the king of bonds, the bond king.
He's old school.
Old school, PIMCO.
Yeah.
So he posted, and when he posts something, especially about interest rates, you listen.
Yeah, everybody, it gets the market's
legend
attention
in our industry.
Yep.
So he posted, post Jackson Hole, interest rate market suggests 3% Fed funds bottom in mid-2027. So 3% Fed funds bottom in mid-2027. If so, then 4% in the 10-year Treasury is a possibility. Still, with billions in supply ahead, 4% is hard to imagine. Staying mildly bearish with expected range of 4.15 to 4.45 over the next few months. Current yield is 4.25, and that's no bargain after taxes.
Yeah. And just keep in mind, he is strictly speaking to the bond market.
Yeah.
Right. So even when you hear the word bearish, I'm not saying he wouldn't or isn't bearish on the equity markets, but he is specifically referring to the bond market. So the takeaway on that was what we were talking about earlier. Hey, Fed funds rate probably come down 3% maybe by 2027, but the 10-year is going to be a little bit more resilient and stubborn, which unfortunately, if you don't know, like that's the driver for mortgage rates and a lot of borrowing rates, lending rates. So if that proves to be true, the Fed can cut, and mortgages may not move at all or very, very little. So,
and that's a misunderstanding that a lot of people have. And I think if you talk to any mortgage lender or most mortgage lenders, they'll say this as well. As Federal Reserve cuts rates, they expect that rates will drop. And that's not necessarily true.
It's just making a huge assumption, but it's not
making
true.
an assumption that the 10-year will follow the short end of the curve, that 1 to 2 year rate that they're setting, because that 10-year rate is not based on the 1 year rate. The 10-year rate is based on what the market
supply and
prices
demand.
risk in the United States.
Yeah.
And if the market sees global demand for U.S. bonds to be dropping because there's a risk in investing in the U.S., the 10-year will stay relatively high, keeping borrowing costs high.
Yeah, which borrowing costs is one of the biggest things that I know that we're hearing all this pressure from President Trump to the Fed to lower rates.
Short end.
Right, and I think that we are assuming he's expecting it to help consumers, right, in the middle class. Two things on that. I think that normal rates going back 50 years were actually less, even at the mortgage rates we're at right now, it's less than the average over if you go back 50 years, right? So, I mean, it's not as, even though it's gone up, doubled in interest rate or more since 4 years ago, which was the gift of all gifts. If you have a mortgage rate under 4%, you should never get rid of that, right? So I don't know that we'll ever get back to those rates. I think a lot of people falsely think that we're going to come crashing back down to those 3-4% mortgage rates again, and I'm not sure how long it's going to take or if ever we're going to get down to that. And that's a good story to that point. It's not always about what the Fed does and the lowering of rates that affect that.
The Fed could effectively drop rates to 0 and the 10-year rate still be 4%.
Exactly.
And it could be 5%.
I know. You go back to 2020, what was the 10-year Treasury at? I mean, it was
like 2.
Yeah, it was under 2. So that goes back to, I don't think we're going to get there and to Bill Gross's point, like we may be overthinking that that's going to happen or we're going to get that, momentum going down. So we just have to be cautious on that.
So if you're betting that your mortgage rate, you're going to be able to refinance it in the next year or two, there's no guarantee. Even if President Trump is able to influence the Fed to cut rates.
Right. But these rates, we might just have to get used to them. These are kind of historical, normal rates.
Yeah. Well, I was trying to pull up the yield curve, like the chart for the 1 month, 1 year, 2 year, 10 year, 30 year, blah blah blah. So you've currently looking at Treasury rates. Let me see if I can get this. So you've got the 2 year is lower than the 1 year. So that's slightly inverted. The 1 month, is higher than the 1 year, 2 year, and 10 year. And so I was looking at that to say, like, the short term, like the short end of the rate, the 1 year, 2 year rates, almost like they need to come down without the 10-year moving in a lot of ways. Just, there's room for that to happen to get and maintain like a normal kind of yield curve environment. So that may have not made any sense, but that's what I was trying to pull up.
That was a lot of numbers.
Sorry. I was over here working diligently trying to get that chart.
I like numbers and I was lost.
Yeah. Just, rewind and listen to what Eli said last. So let's hope Ryan Detrick is right with his history hey, this is could be the start. I know there was another chart that I put out of what the market does after the first Fed cut. And it was kind of showing a different view of like, hey, sometimes, it can be really good, but it can also not mean the market does well. So it's not like the best indicator, but we'll stick with Ryan Detrick and hope he's right. So, and then I think important takeaway is, the Fed funds, hey, it's great, rate cuts, all that, good or bad, whatever, but that doesn't mean that borrowing rates, mortgages are going to come down at the same time, if at all. I mean, you could see mortgages go up, right?
Exactly.
Even as the Fed is cutting, which is kind of mind-blowing for a lot of people, but that is everything we just walked through is why that is true. So, anyways, any parting words, thoughts?
If you're going to retire, it always depends.
Exactly. Exactly.
Yeah, people love hearing that.
Yeah. Exactly. But it's not simple math.
Yeah, good conversation.
Yeah.
I really enjoyed that first part of it, for sure. So, as always, we appreciate you guys watching and listening. Give us a like, subscribe, comment, shoot us an email, and we'll be sure to jump into the next question next week that we get all the time. We'll see you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.